Welcome back. You ever look at a huge company, like an Apple or a Google, and just wonder, what's it actually worth? Well, today we're going to put on our detective hats. We're diving deep into a company's financial statements to find its true value. It's a really fascinating search, so let's get right to it.
Okay, let's just jump straight in, because right away we run into a central mystery. On one hand, you've got book value. That's what the accountants, the books, say a company is worth. And on the other hand, you've got market value. That's what the stock market, real people, say it's worth. So how can these two numbers for the very same company be, well, worlds apart sometimes? That's the puzzle we're here to solve.
To really crack this case, our first move is to truly understand what each of these values is trying to tell us. Book value is all about history. It's literally what the company paid for its buildings, its computers, its factories, and we could be talking decades ago. This is something called historical cost. Think of it like looking in your car's rearview mirror. It shows you exactly where you've been, but it doesn't really tell you much about where you're headed. Market value, though, that's a completely different game. It's all about the future. It's what investors are willing to pay right now based on how much cash they think the company is going to make tomorrow, next year, even 10 years from now. So here's the absolute crucial point. Book value is looking at the past. Market value is making a bet on the future. And that changes everything. All right, let's move on to our first set of clues, the balance sheet. This is the first document we really need to get our hands on in this investigation. So what is a balance sheet? Well, it's pretty much what it sounds like. It's a financial snapshot taken at a single moment in time. It's like you hit pause on the entire company on, say, December 31st, and took a picture of everything it owns and everything it owes. It's a static image of its financial health on one specific day. Now here's the really cool part, the core principle of all accounting. The two sides of this picture have to balance. They must always be equal. Everything the company owns, its assets, had to be paid for somehow. It was either paid for by borrowing money, which creates liabilities, or by using money from investors, which is the shareholders' equity. So let's quickly break that down. Assets are all the useful things, right? The cash it has, the products in its warehouse, the machines in its factory. Liabilities are its debts, the loans it owes the bank, the bills it has to pay its suppliers. And shareholders' equity? Well, that's what would be left over for the owners if the company were to sell all its assets and pay off all its debts. It's what remains. But here's the catch with our first clue. It has a big limitation. A factory that was bought back in 1985 is still on the balance sheet for what it cost in 1985, minus a little for wear and tear. It tells us absolutely nothing about what that land or that building is actually worth today. So the balance sheet is important, for sure, but it's not giving us the whole story. Okay, so now let's turn to our second piece of evidence, the income statement. Now, this one seems a bit more promising because it's supposed to tell us if a company is actually making any money. Right, so if the balance sheet was a snapshot, a photo, then the income statement is the video. It doesn't show you just one moment. It shows you the action over a whole period of time, like an entire year. It's tracking all the money coming in and all the money going out. And the path is actually pretty logical. You start at the very top with your total sales, your revenue. Then you just go step by step, subtracting all the different costs and expenses, interest and taxes, and what you're left with, way down at the end, is the net income. You've probably heard it called the bottom line. This is the company's official profit. So this seems pretty straightforward. A company with a huge profit, a really big bottom line, well, they must be just swimming in cash, right? I mean, it makes sense. But what's really fascinating here is the answer is, surprisingly, no. And this right here is the big secret the income statement is hiding. Profit is not cash. A company can be reporting record profits and, believe it or not, still be heading towards bankruptcy because it's running out of actual money. This is an absolutely critical distinction to understand. So why? How is that even possible? Well, there are two main culprits. First, it's the accounting rules. The official standard, called GAAP, says you can record a sale the second you make it, even if your customer isn't going to pay you for another 90 days. So the profit is on your books, but the cash isn't in your bank account. Second, you've got these weird non-cash expenses like depreciation. Accountants reduce your profit to account for your equipment getting older, but no actual cash leaves the building for that. So if profit is really just an accounting opinion, how do we find the cold hard facts? This brings us to our final and, honestly, most important clue in this whole investigation. finding the real cash. Let's forget all the complex rules and jargon for just a second. At its heart, cash flow is this simple. It is the raw count of the dollars that physically came into the company versus the dollars that physically went out. That's it. It's financial reality. And this reveals another one of those fundamental laws of finance. Just like the balance sheet, cash has to balance out. All the cash that a business generates from its assets has to go somewhere. It either goes to the people who lent it money, the creditors, or it goes to the people who own the company, the stockholders. The number that we are really hunting for is this one: cash flow from assets. You'll often hear people call it free cash flow. And why is it free? Because it's the cash that's left over after the company has paid for all of its day-to-day operations and invested in its own future. It's literally free to be given back to the investors. And we find it by starting with all the cash that came in from the core business. Then we have to subtract the money the company spent on new equipment or buildings. And finally, we subtract the cash that got tied up in just running the place day to day. What's left over after all that? That's the pure, unadulterated cash-generating power of the company. So after looking at the clues from the balance sheet and decoding the secrets of the income statement, our whole investigation leads us to one final verdict. What's the one thing above all else we should really be looking for? And here it is. This is the single most important takeaway from all of this. Accounting profit, it's subject to rules, to estimates, to timing. It's basically an opinion. But cash flow? You can't argue with cash flow. It's a fact. A dollar either came in or it went out. Simple as that.
So, at the end of the day, why does all this matter? Well, because book value is stuck looking in the past, but all of a company's value is created by the cash it's going to generate in the future. It's how we know that a company with huge profits isn't necessarily safe. If it can't manage its cash, it can still fail. Ultimately, if you really want to understand a company's true health and its true value, you have to follow the cash.
So I'm going to leave you with this. The next time you see a big headline celebrating some company's record profits, you'll be one of the few people who knows to ask the much more important question, that's nice, but what does their cash flow look like? Thanks for joining this explainer.